Welcome back to lecture 14 on financial mathematics for actuaries. Today we are going to discuss a very important topic and we will reveal one real time paradox that is available when we invest in mutual funds. So for that we need to consider two things. One is dollar weighted rates and second is time weighted rates. Let's jump on to what is our agenda today. As I mentioned, we will reveal one paradox that is there in the mutual funds cash flows. So that is what we will first, our premise of this lecture will be based on this paradox which deals with performance measurement of cash flows. What we will do is we will first give you method 1, which is dollar weighted rate, which is also called internal rate of return, and we will contrast that with the second method that we will introduce, which is time weighted rates. Okay, and why these two are essential, that also we will discuss, and then we will use some approximation to actually calculate the rate of return. This is simple interest exposure method, and with that we will precisely resolve the paradox and we will see which method of computing the returns is more helpful and which method is not, in what context. So by the end of this class you will be having a complete idea of these concepts. For your clear understanding, we refer you to Browerman section 5.2 and Chan and Say section 4.2. Okay. So as I mentioned, our lecture revolves around a paradox. So let me state the mutual fund paradox. Here is a mutual fund paradox. Assume this scenario. At Jan 1, you have deposited $100. So the fund value becomes $100. At June 30, which is the next next investment time, your fund has actually doubled to 200. You have seen good returns. Now you decide to add $200. So your total fund at the end of June 30 will be $400. And then when the year ends, that is December 31, market actually crashes by 50% and the fund value now reduces to 200. Okay. So I hope the scenario is very clear. This is a usual scenario when we deal with mutual funds, and that is why the disclaimer: mutual funds are subject to market risk. Okay. So now in this case the manager actually says, okay, I doubled the money and then I lost half. So overall the performance of my fund is break even. So 0%, no profit, no loss. Whereas when you look at the investor, investor says, okay, I have put $300 in total, I am left with 200%. So I lost my money. Okay. The question is, who is right? Correct? We will address this question in today's lecture. So what do you think? Who is right? Just think about it. And now we will look, as you can see, this particular scenario involves some cash flows. We will look at two methods, as we discussed earlier, of understanding these cash flows. So the first method that we will deal with has to deal with dollar weighted returns, DWR. This is also called internal rate of return. What it worries about is it measures the investor's actual experience. It is sensitive to time and size of the deposits or withdrawals. Okay. So this is how we will equate it. So how will we handle this? We have our favorite tool, right? Equation of value. So we will use that equation of value to handle this. So at t equal to 1, the equation of values, that is the end point, the equation of value is present value of inflows equal to present value of outflows. Okay. So if you look at the focal date is t equal to 1, then the initial fund would have gathered the interest of I. So, initial fund into 1 plus I will be the initial funds value at t equal to 1. In between you might have deposited some amount. So, each amount that you have deposited we will attribute Ck, this is a contribution of yours, and it will accrue an interest rate until the time point 1 from which you have deposited. So, it will be 1 plus I raised to 1 minus Tk, and together all these things will actually give me the final fund amount, which is final fund, right. So, this is t equal to 1, or you can use discount factors, in which case you are bringing it to present value. Okay. So, you are bringing t equal to 0, then initial fund will be initial fund, all the Ck's that you have deposited you have to discount up to time Tk. So, V raised to Tk, and the final fund times V, which is the discounting by factor of 1. So, it will come back to 1, right. So, in both ways we can easily compute these dollar weighted returns. Okay. So, let us so we have understood the terminology, inflows and outflows, deposits, withdrawals, all are considered here. If there are deposits, deposits will come with a positive sign. If there are withdrawals, withdrawals will come with a negative sign. Okay. So, with this understanding, let us actually solve one cash flow problem, that is the one that we have said. So, if you look at the cash flow problem that we discussed, there was a 100 deposit at time 0, then in the middle of the year there was a 200 deposit, and in the end of the year the value of the fund that we coined as outflow was 200, correct. So, if I put this into the equation of value at t equal to 1, which is my focal date or the terminal date in this case, it is 100 into 1 plus I plus 200 into 1 plus I raised to 0.5, which is 1 minus Tk, right, which is equal to 200. Can I solve this? Yes. How will I solve this? I will put this 1 plus I to be equal to square root of V, because I have this raised to 0.5 here, right. So, I will put this notation, and then let x denote square root of 1 plus I, then this 1 plus I will become x squared. Okay. So, then I have a quadratic equation ax square plus bx plus c. I will divide everything by 100, then I got a simple quadratic equation. I will solve this using discriminant formula, which is very easy to solve. I have to identify a, b, c and give the discriminant formula. That will give me the roots of this discriminant formula to be equal to minus 2 plus minus root 12 by 2. So, root 3 minus 1 and root 3 minus 1 is a valid root, all other root will be negative. So, we will ignore that root. Okay. So, if I solve it using this, then you can easily see I will substitute this value of x into the expression and calculate 1 plus I, which will be 1 plus I will be 0.732 squared, which gives me 0.5358, and I is equal to 46.4%. This is our investor's perspective. He put $100 at the initial period, he saw the growth of a fund, so he doubled the amount and put $200 in the middle of the year, after which the market has crashed and he lost roughly around 46.4% of his capital, right. So, this is the ideal situation which the investor looks at. Now, we will give you the different perspective. So, it is the timing of the investor that is causing him the ruin. Why should a mutual fund portfolio manager should be penalized for that? The next perspective comes from this particular angle, and it is called time weighted return. So, what is a time weighted return? It is the geometric mean of sub period returns. So, what does it constitute? It actually looks at manager's performance, the portfolio manager's performance, and it ignores the timing of external cash flows, because investors may decide to put any cash flow in between. Why should a manager be penalized for that? So, how will I do this computation for time weighted return? So, there is a simple procedure. First, what you do, the manager at the beginning of the period of every sub period will decide how the cash flow, how the investment will be made, right. So, what we will do is we will break this year, entire year, into sub periods at every cash flow. Whenever new cash flow comes, the manager will actually decide to invest that money, okay, and how he invests is his forte. So, in order to do that, whenever the cash flow has occurred, we will break the time periods and we will calculate the holding period returns for each period. How will we do that? That is, there is a simple formula for this. So, what we will do? We will look at the value of the fund before the new cash flow has arrived, okay, and before this new cash flow, the fund has started with some amount. So, essentially we are looking at the interest accrued in that particular thing, okay. So, that is the amount that has increased, okay. So, naturally it will be equated with 1 plus jk. This is equivalent to our accumulation function divided by whatever is the initial period capital that is being removed, okay. So, this is the amount grown. Now, you relate this for each sub period, you calculate this, and now you relate this with your interest, which is time weighted return, because at every time new cash flow comes, the money enters, that will be pushed into fund. So, you link this in with this formula. This we have done several times. So, 1 plus ITWR is the number of periods that are available till the end, and at every time period you have evaluated the cash flow and what is the interest gathered and how the amount has moved. So, 1 plus J1 into 1 plus J2 and so on up to this. So, let us look at the problem and understand what we are saying. So, now we have started with $100 of initial deposit, and at the end of half year we reviewed the portfolio and saw the amount is 200. So, what is 1 plus J1 in that? It is 200, which was fund before the new cash flow, divided by fund at the start of the period. So, 200 by 100, which is equal to 2. In a similar manner, you will again review the next one for the next period, that is July 1 to December 31. You already had 200, which was the amount at the starting period, plus you pushed $200 fresh amount. So, together at the start of the period we had $400, and towards the end we got $200. So, in this case, the before the new cash flow, the amount is 200 divided by amount at the start of the period, which is 400. So, it reduces to 0.5. So, the time weighted return in this case will be 1 plus I equal to 1 plus J1 into 1 plus J2, which is 2 into 0.5, which is equal to 1, and therefore, the interest accrued is 0%. Let us put everything on the timeline for clarity. So, this is my timeline. This is the point t equal to 1, this is the point t equal to 0.5, and this is the point t equal to 0. So, what happened within this period? This is my period 1, this is my period 2, and how much is the amount change? It is 1 plus J1 during this period, 1 plus J2 during this period, and then what was the amount that is given to me? 100. Before the actual thing starts, it was 200, and then some cash flow came, which is 200. Therefore, together the amount was 400, and then what we got in the end is 200. So, this is how you can depict that graph. Okay. What we can do for the previous one, which is a general thing, you can go back and we can look at this particular expression. So, again you can divide it into as many parts as you want, and this is t equal to 0. So, let us divide it into t equal to 0, t equal to 1, t equal to 2, t equal to 3 and t equal to 4, let us say. Okay. So, at each period from 0 to 1 I will accrue interest of 1, I will accrue this 1 plus j1, that is a change in the amount. This will be 1 plus j2, this is 1 plus j3 and this is 1 plus j4. So, then while computing this TWR, I will take product of 1 plus j1 to 1 plus j4 together. So, it is 1 plus j1 into 1 plus j2, 1 plus j3 up to 1 plus j4. So, it depends on how many periods, sub periods I split the year into. Okay. So, this is the basic understanding of our 1 plus j1 and 1 plus j2. Remember that this actually takes the fund value implicitly, it does not take the actual amount of value, because fund at the start of the period is divided by in the numerator. So, if you push more cash flow, that will come in this particular thing. So, it does not actually penalizes our mutual fund manager for having more fund at that particular time, because this is the timing of the investor. Okay. So, from this this particular calculation, and after understanding all these things, it is very clear that the manager is not responsible for how much cash flow comes. Therefore, manager is not penalized for his job. So, we assume that he did his job neutrally, correct. So, now we have actually shown you two ways of computing. One is favorable for a mutual fund manager, another one is favorable for an investor. So, here is the verdict. Whatever case mutual fund paradox that we have shown, DWR is the right way to calculate for investor, and the result with DWR is the investor has lost 46.4% of his capital. For a manager, it is good, it is 0%, no growth, he broke even. Okay. So, the logic for the investor is I bought at high level and therefore I am actually paying the price for that buying at high level for my greediness, and for a manager it is I broke even. So, what is the sensitivity of DWR? It is basically when you are pushing the money. So, cash flow timings are crucial for pushing the money into mutual fund, and for a manager it is just market movements. Okay. So, the behavior, you just look at the behavior, this DWR actually penalizes you for the bad timing, and TWR, because it is assessing the manager's performance, it is neutral to the timing. Okay. It depends on the decisions that the manager is making. If you have large deposits that are made just before the crash, that means I bought high, then what will happen? Your DWR will always be less than TWR. However, if your timing is right, that means you are essentially making deposits just before the boom, then you are able to capture that full growth curve, then your DWR will be greater than TWR. So, it is the game of timing even while investing in mutual funds. Okay. So, this is the basic key understanding of our time weighted and dollar weighted returns. Now, we will look at how to optimize this, or in what way I can assess my timing, right. So, that is where you have to improve your DWR over TWR. That's the idea. So how will you approximate these DWRs? That is what we will look at the next. So what exactly is DWR? Finding exact DWR, as we have seen, will always require solving polynomials, and we have seen some interpolation technique or IRR methods of calculator for doing that. But the simplest way, which is the simple interest method, we call this as exposure, simple interest exposure method. What we will do is, essentially we will look at the net interest that we have earned and we will divide it by the exposure we have to the market. Okay. So these are the two key factors. So how will I compute the net interest earned and how will I compute the exposure that I have in the market? So those rely on simple basic principles. What is interest? It's basically there what is the end date, and at that time what was my capital or the amount in my account, and what is the start date, how much I invested, right? In between I have made some contributions, right? So so those contributions also come in between. Therefore I will subtract all the contributions that I have made and I will look at the end date what is my capital. Okay, so that's the simple calculation for I. And how will I calculate exposure? So how much money I have put in that portfolio, that's what is important for me. So at the starting period, the initial time period, I put some capital, so that is my start, and it is exposed throughout the year, so that year is 1. Okay. In between, whenever I put, say I choose time Tk to invest certain to contribute to that portfolio, let us say that contribution is Ck, then the exposure that this Ck amount will have is 1 minus Tk, because from Tk to the end of the year, so 1 minus Tk. Therefore my exposure will be calculated as sum of all these contributions whenever they are credited multiplied by 1 minus the time of the credit. So what is exactly this exposure? It's basically weighted average amount of the capital actually working in the fund for the year. Okay. So if you are clear with this, then it is very easy to calculate this simple I. Okay. Let us do one example. Again I will take one more example where I have Jan 1 where $1000 are there. So this is my start. Then in April, this is the first quarter over second quarter's beginning, we deposit 500 and we evaluate the fund at the end of the year, which has a value of 1600, right? So how will I calculate the net interest on this? It's basically end is 1600, deposit of 1000 which is start, so 1600 minus 1000 minus the deposit which I made in the middle. So these are the deposits that I have made. So 1600 minus 1000 minus 500, so it will give me 100. So this is the interest that I have accrued over this period. So what was my exposure? Again you look at this, there are two deposits that I have made at the beginning, $1000 which is exposed for one full year, so 1000 into 1, and I deposited $500 at the beginning of the second quarter, and therefore it is exposed for next 3 quarters. So the first quarter is 0.25, therefore 1 minus 0.25 will give me 0.75. So 1000 into 1 into 500 into 0.75 is my exposure. Together if you sum, it gives me 1375. So a simple approximation, then you do the division, 100 by 1375, whatever is the interest gathered is the interest accrued in this particular calculation. Okay. So now here we have only deposits, there may be some withdrawals in between. For example, you may decide to withdraw $200 in the middle, say let us say at 0.6, t is equal to 0.6, what will happen? Will it increase your exposure or reduce your exposure? Definitely, if you are withdrawing, you are reducing your exposure. So, how will you handle that? If you withdraw say $200 at t is equal to 0.6, then your contributions, that CK that you are looking at, so in this case it is a second, so is minus 200, and then the denominator, that exposure that you are calculating, will be actually 200 into 1 minus 0.6, because that exposure you have reduced for that period. And how much exposure you have reduced? It comes out to be $80. So, you subtract it from that, and that is how you will calculate the returns, interest rate. Okay. So, I have cleared exam trap. Now, one exam tip: in exams you may be asked to calculate linked internal rate of return, linked IRR. Okay. So, this is actually hybrid. So, what you have to do is, you essentially need to calculate the dollar weighted return for each sub period, and then the way we did for 1 plus j1 TWR, right. So, the way we did, so you just link them as 1 plus I equal to 1 plus I1 in this particular period, 1 plus I2 in second period, and so on till you reach the end of the period. This will account for the cash flow timings within the periods and links them fairly. So, this we can see in some of the assignment problems in our assignments. Okay. So, now that we have learned the we have understood how mutual fund paradox can be resolved, and how TWR and DWR are helpful tools, let us revise what we have learned in today's class. First, we looked at DWR, we established the equation of value, and this tool is best for assessing your growth of your capital. TWR is basically a sub period linking, and it actually assesses the skill of the portfolio manager. And when you actually need to understand how much interest you have earned, you use this approximation, which is interest divided by exposure, and this approximation is fast and robust. One more point, that this time weighted return is an industry standard for mutual funds. Okay. So, thank you for listening to this lecture, and in the next class we will actually combine everything, and we will solve some exam style problems, where we will look at unknown time with drop payments, we will look at how to interpolate I, we will calculate TWR versus DWR for a complex fund which has many deposits and withdrawals. Okay. So, see you in the next class.